Hello. In this video, we'll be going over IRS Form 1099-A, Acquisition or Abandonment of Secured Property. So lenders will file this form for each borrower if they lend money in connection with their trade or business and they acquire an interest in that property that secures the debt, and or if the lender has reason to believe that the property has been abandoned. For example, a primary residence that's secured by or a mortgage that's secured by a primary residence, perhaps a car that's been repossessed, things of that nature where the lender actually acquires the underlying security that is the collateral for the loan. However, lenders may not always file Form 1099-A if they cancel a debt that is $600 or greater in connection with a foreclosure or an abandonment of property. Instead, they may file IRS Form 1099-C since they're already required to do so. That's the debt cancellation tax form, and they can report the basic information that's required on Form 1099-A, which is the outstanding loan balance and the fair market value of the property. That can be reported on 1099-C. The primary tax implication to the taxpayer or the borrower is depends on whether or not the fair market value of the property that they gave up or abandoned is greater than or less than the balance of the principal that was outstanding. So if the fair market value of the property that is listed on Form 1099-A is less than the outstanding balance and that balance goes away, there may be tax implications and they may need to report that on their tax return. So we'll cover that a little bit more detail later in this video. We do cover it extensively in our article, so we'll put links to our article in the show notes. Let's go ahead and walk through the tax form itself. So on the left-hand side, we'll see the tax information for the lender and for the borrower. So in this case, our hero, John Doe, his lender is Acme Lending Solutions, and they are filing this Form 1099-A, and they're giving this borrower's copy to John Doe. This is copy B, so copy A of any 1099 always goes to the Internal Revenue Service. Copy B, in this case, goes to the borrower, and then there's a copy C, which Acme Lending Solutions will retain for their records. So in copies B and C, you'll see that the borrower's taxpayer ID number is truncated, meaning that they're only going to show the last 4 digits of either the Social Security number, the individual taxpayer ID number, it could be an adoption taxpayer identification number, or it could be an employer ID number. So the copy A that goes to the IRS will always contain the full tax ID number. So we've got John Doe's contact information, his street address. Acme Lending Solutions would normally enter their phone number. So let's put in their get their phone number in there. And if they add an account such as some sort of a banking account number, you might see that under the account number field, but it doesn't, there's no practical purpose. There's no tax impact if they don't have that. So on the right-hand side of the form, we have 6 basic fields. They're fairly straightforward. So this was for calendar year 2023. On this form, the lender, Acme Lending, is reporting that they acquired this property or they knew that it was abandoned. It could be either or on June 1st, 2023. So if in the case of an acquisition, this would be when they actually foreclosed on the property, when they actually had the deed or the rights and burdens of ownership of that property. So the interest in the property is usually acquired on the earlier of either the date that the title is actually transferred or the date that the lender has to start taking over the burdens and benefits of owning that property, paying property taxes and things of that nature. For in the case of an abandonment, that's a little bit different. Like in the Great Recession, when thousands of homeowners just walked away from homes, banks had a hard time of knowing exactly when that abandonment took place. So this would be reported as the date that the bank or the financial institution knew or had reason to know that the property was abandoned under normal circumstances, unless they were already going through a foreclosure proceeding or something of a similar nature. In box 2, it's going to be the balance of the principal outstanding. It's going to be less than the loan amount, and it's not going to include any interest that was accrued. So it's only going to include any unpaid principal on the original loan balance. And this will be as of the date indicated in box 1. Box 3 is reserved for future use, so there should be nothing in that field. Box 4 is going to indicate the fair market value of the property. If it was sold at a foreclosure or an execution or some similar proceeding, then it would generally be the sales price. Otherwise, it might be the appraised value. If this box 5 is checked, then the form instructions indicate that this fair market value of the property should be the same as the appraised value of the property. So in the case of a primary residence, this would be based probably on whatever if the bank or financial institution obtains an appraisal. So depending on their internal rules, it might be the appraisal used to justify the loan. If a certain amount of time has passed, they may request another appraisal to update that fair market value. And the reason why it's important for a taxpayer to know this is because the difference between the loan balance and the fair market value of the abandoned property can play a role in determining whether or not you need to claim or recognize a capital gain for tax purposes. So yes, it is theoretically possible for a taxpayer to abandon property and still walk out on the loan and still have to pay taxes on the forgiven amount. And then in box 6, this is going to contain the description of the property. So the form instructions have detailed guidance on how to enter real property, personal property such as a vehicle, or things like office equipment. So in this case, it would be the address of the property. So we'll say that it wasn't his primary residence, but it was a rental property that he had down the street. So you might see other supplementary information. It may be single family residence, things of that nature. So there's not a whole lot of specific guidance in the form instructions for what borrowers should do, but there are resources on the IRS website to help people determine whether or not they need to report abandonment of property for capital gain purposes. So we do outline this based on different criteria. For example, there's a different treatment of fair market value based on whether or not this was recourse debt or non-recourse debt, and whether or not the property was used for business purposes or not for business purposes. And then there's also an exclusion, a tax exclusion available through to 2026 for qualified principal residence abandonments or debt cancellation. So if you had a Form 1099-A or a 1099-C, most likely, for debt cancellation on your primary residence, you may be able to exclude that amount up to $750,000. So that's all we have for this tax form. We'll put a link to the article in the show notes. We'll also put links to relevant articles and videos we've created on other tax forms and schedules that may be necessary if you're reporting this or having to calculate any possible tax impacts. So we'll put all of those in our show notes. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our channel. And if you have any questions or comments, or if there's something that you'd like me to cover in a future video, please post a comment in the comments section. Thank you very much and have a great day.